Welcome to Miller Momentum. Today we are going to talk about Premia decay, which is the decline in the amount of extra return or juice you can squeeze from an academic factor like momentum or value over time. And it's also one of the primary reasons why I combine value and momentum in some form in all of the portfolios that I design. Before we get started, a disclaimer is in order. I am not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. Today, we're talking about two of the most famous ideas in academic investing, the value premium and the momentum premium. For decades, these two strategies form the backbone of factor investing. Buy cheap stocks, the academics said, and that's value. Buy stocks that have been going up, they said, that's momentum. And the data backed them up across markets, across decades, across asset classes. But since around 2007 or so, both factors have had serious problems that most people aren't aware of. Value went through a historic drought that lasted more than a decade. The pure academic form of focus momentum kept generating crashes, sudden, brutal reversals that wiped out months of gains in a matter of weeks. And some researchers started asking, are these premiums even real anymore? Before we get into what went wrong, let's quickly establish why these two factors matter so much in the first place. The value premium was formally documented by Eugene Fama and Kenneth French in 1993. The idea is simple. You buy stocks that are cheap relative to their book value, their accounting value that is, and sell the expensive ones. Historically, over the period from 1963 to around 2007, right before the Great Financial Crisis, cheap stocks beat expensive stocks by about 6% per year. That's a huge edge in a world where index funds earn zero alpha. Momentum was documented that same year, 1993, by Jagadish and Sheridan Titman. Their findings, stocks that have gone up over the past year tend to keep going up over the next several months. That strategy, in contrast to value, posted around 10% per year in US equities all the way through the 1990s. Both findings were replicated across dozens of markets and asset classes, and crucially, they move in opposite directions, which makes them very complementary. When one zags, the other zigs, and so forth, making them powerful complements in a portfolio. So we had two robust, well documented, theoretically motivated return premia, and then something changed. Now, let me be clear. The problems with value and momentum are not the same. They look superficially similar, two strategies that used to work very well and now seem to work a little less well, but the underlying causes are completely different. Value's problem is structural and definitional. The way that we've traditionally measured value, using book value divided by market price, has become an increasingly noisy proxy for what we actually care about. Some argue the economy has shifted toward companies whose most valuable assets don't even show up on the balance sheet anymore. The measuring stick broke. But the underlying idea that cheap assets should outperform expensive ones, that idea is still around and very much alive. Momentum's problem is different. The signal itself, past returns predict future returns. I know that sounds contrary to everything, but in Momentum's case it's true, hasn't become harder to measure. What's happened is that the premium has been competed away to some degree. It will never completely disappear, of course, but it is now subject to a diminishing returns cycle. Too many smart investors discovered momentum, built models around it, launched products tracking it, and flooded the trade with capital. When everyone does the same thing, the edge disappears. The movie Incredibles taught us that, right? When everybody's special, nobody's special. The distinction matters enormously, though, that is, between the problem with value and momentum in terms of what investors should do about it. Value needs better measurement. Momentum needs either a way to capture the surviving premium more efficiently or acceptance that the premium is structurally smaller than it used to be. So let's start with value. The numbers here are stark. From 2007 through mid-2020, the Fama-French HML factor, which is the academic long-short portfolio that captures the value premium, fell 55%. That's a massive drawdown by any measure. To put it in context, this wasn't a bad year or even a bad few years. This was 13 years of value stocks losing ground to growth stocks, almost without interruption. And it wasn't just one researcher's finding. Fama and French themselves, the people who defined the factor, published a paper in 2021 in Review of Asset Pricing Studies documenting this decline. They compared two subperiods. So in the first period, from 1963 to 1991, the large stock value premium was about 4.3% per year. In the second period, 1991 to 2019, it dropped to just 0.6%. For small stocks, the premium fell from 7% to 4%. Now, here's the important caveat that Fama and French themselves made. Given the high volatility of monthly factor returns, the statistical test cannot reject the null hypothesis that the premium is unchanged. In plain English, the data are consistent with a genuine structural decline, but the data are also consistent with a very unlucky stretch of returns from a still healthy premium. The sample is just too noisy to be definitive, and that ambiguity is important, and it's why this debate has been so fierce. So why did value underperform growth so badly? Let's start with what I think is the most important structural explanation. Book value alone has arguably become a broken measuring stick. So here's the issue. Under U.S. accounting rules, GAAP, when a company spends money on R&D or research and development, or on building its brand, or on developing the organizational systems that make it run efficiently, that spending flows through the income statement as an expense. It never becomes an asset on the balance sheet. For most of the 20th century, this wasn't a huge problem. The most valuable companies were, after all, manufacturers, oil producers, and banks. Firms whose value was tied up in factories, equipment, land, and financial assets that accounting does capture. But today, the most valuable companies in the world are often software firms, pharmaceutical companies, and consumer brands. So companies like Apple, Google, Nvidia. Their most valuable assets, the code, the patents, the brand, the talent, are nowhere on the balance sheet. So when you compute book to market for these firms, you get a very high ratio. They look quite expensive. When in fact, once you account for the intangible capital that they're quietly building, they might actually be arguably pretty cheap. Eisfeld, Kim, and Papanicolaou at Northwestern showed in 2022 that if you adjust book value to include estimated intangibles, you get a factor. They call it HML-int, int for intangible, that delivers substantially higher returns than the traditional HML factor, especially in the period when traditional value was struggling. So the measuring stick was wrong according to them, and the premium wasn't dead. There's a second accounting distortion, though, that's probably way more important, in my opinion, that's contaminating the value signal, and this one is less well known. It's the treatment of goodwill after acquisitions. So when one company acquires another and pays more than the fair value of the target's net assets, the excess is recorded as goodwill on the balance sheet. Before 2001, goodwill was amortized. It declined on a regular schedule, like depreciation, and that made it relatively benign. But in 2001, the Financial Accounting Standards Board issued SFAS 142, which eliminated periodic amortization. Under the new rules, goodwill just sits on the balance sheet at its original value until management decides it's impaired and takes a write-down. Lee and Sloan in 2017 showed that managers delay those impairments opportunistically. Surprise, surprise. So goodwill balances are systematically overstated. By the end of 2019, goodwill represented nearly 40% of aggregate book equity for U.S. listed companies. That's enormous. What this means for value investing is that companies with heavy M&A histories, which may have paid high prices for acquisitions, show up with big book values and low price to book ratios. They look cheap on a naive HML screen when their balance sheets are actually inflated with acquisition premiums that may never materialize. So the fix is straightforward. Strip goodwill out of book equity before computing the value signal. And that's exactly one of the things Avantis does, which we'll get into. Now here's the crucial question though. Was Value's decade-long underperformance evidence that the premium is dead, or was it something else? Research affiliates, and specifically Robert Arnott and the co-authors published in the Financial Analyst Journal in 2021, did a detailed return decomposition. They broke the drawdown into its components and asked, where did the losses come from? Their finding is striking. Changes in the valuation spread between cheap and expensive stocks explain the entire drawdown according to their research. The spread, the gap between how cheap value stocks are and how expensive growth stocks are, went from historically normal levels in 2007 to the most extreme levels ever recorded by 2020. Value stocks didn't fail to deliver their fundamental returns. Rather, what happened was a re-rating. Growth stocks became dramatically more expensive relative to value stocks. The distinction it matters enormously because there are two very different reasons a factor can underperform, right? One is the premium has been arbitraged away, so too much capital flows in, prices adjust, and the edge disappears. If that's what happened, you shouldn't expect recovery. The other, however, is that valuations moved against you. Not because the fundamentals changed, but because sentiment flows or the macro environment pushed prices apart. If that's what's happened, then the very cheapness that caused the drawdown is itself the setup for future outperformance. The spread has to mean revert. It always has, historically. The question is when. Arnett et al. Say it's the second story, not the first. Value isn't dead. It's just really, really cheap right now. Now let's turn to momentum. At the core problem, here is different in nature than values. Values is definitional and structural. Momentum's a lot harder to fix. The numbers are striking. Momentum returned something like 10% per year through the 1990s, and today that figure is closer to about 2%. That's an 80% reduction in the realized premium. Something has clearly changed here. The most rigorous academic evidence on this pattern comes from R. David McLean and Jeffrey Pontiff, who published a landmark paper in the Journal of Finance in 2016. So they looked at 97 different return predictors, academic factors, anomalies, strategies, and looked at what happened to their returns after they were published. Their finding, out-of-sample returns were 26% lower than in-sample. But post-publication, returns were 58% lower. That 32 percentage point gap between the out-of-sample decline and the post-publication decline is the smoking gun. It's attributable specifically to the act of publication. When the academic community reveals a strategy, investors with models pile in, and the edge erodes because now everybody is chasing it. This is sometimes called the factor zoo problem, but it's really just standard arbitrage economics. Momentum, with its simple, transparent, easily replicable signal by last year's winners, was a prime target. Once it was published, everyone could do it. And when everyone does it, the premium gets competed down. That's just the mathematics of the situation. Falk, Reg, and Thesmer in Quantitative Finance in 2022 confirmed this pattern across a broader set of systematic strategies, finding an average post-publication Sharpe ratio decline of 43%. So why is momentum especially vulnerable to this kind of crowding? Well, it comes down to a fundamental property of the strategy. Jeremy Steen of Harvard, need to pronounce words better today, gave a presidential address to the American Finance Association in 2009. This was right before the financial crisis, and very prescient. where he distinguished between anchored and unanchored strategies. An anchored strategy is one where an investor can compare the current price to a fundamental value, and if something is too crowded, the prices eventually return to fundamentals and the arbitrage reestablishes. A value investor can assess whether a stock is genuinely cheap by looking at earnings, cash flows, or assets, at least in theory, provided they're looking at the right things to assess value. Momentum has no such anchor. There's no fundamental to compare to. A momentum investor just buys what's been going up. If too many investors are doing the same thing, no one knows when to stop because there's no reference point saying this has gone too far, guys. This makes momentum uniquely susceptible to coordination failures and crashes. Lowe and Polk at LSE provided direct empirical evidence in 2022 using a measure they called co-momentum, essentially the abnormal correlation of returns among momentum stocks. When this correlation is high, it means many investors are holding the same names, which signals crowded positioning. They find that returns are 1.07% lower per month in subsequent periods when co-momentum is high. And the rise of momentum ETFs after 2015 has made all of this worse, as you might imagine. When a transparent, rules-based ETF tracks a momentum index, every investor who holds it is contributing to the same crowded trade at the same time. Beyond gradual alpha decay, momentum has a specific and dramatic risk profile that makes it uniquely dangerous when used alone and not paired with a complementary strategy, say like value. It's prone to sudden catastrophic crashes. And if you don't have something to refill its ammo when it runs out, well, it can take a long, long time to recharge. So Daniel and Moskowitz at Columbia and Chicago showed in 2016 that despite momentum's strong average returns, it experiences what they call panic state crashes. Brief, extreme, really hard to predict reversals that can wipe out months of gains in a matter of weeks. The examples are vivid. Momentum lost 88% in just 2 months in 1932. That is the long short version of it. The long version actually came out a little bit better than that. And it lost 46% in 2 months in 2009. And yeah, SPMO had a pretty bad crash back then too. I believe it was 62% if you look at the index. Anyway, the mechanism is surprisingly logical once you understand it. In a bear market, momentum's long leg is recent winners, firms that have held up well, right? The short leg is recent losers, often distressed, financially fragile companies. So when the market crashes, those distressed firms are beaten down even further, momentum profits. But when a sharp market recovery happens, a panic reversal, those distressed short positions explode upward. Highly leveraged, financially fragile companies are the most sensitive to a market bounce. And momentum's short position, which is these exact companies, gets crushed. The strategy effectively behaves like a written call option on the market in bad times. And that's why most modern equity ETFs for retail investors are long only. So SPMO is not going to short anything. MTUM is not going to short anything. I want to be clear about that. So they escape the worst half of the crash. Anyway, Daniel and Moskowitz quantify this elegantly. In bear market states, momentum's up market beta, its sensitivity to market rallies, is negative 1.51. In plain English, every 1% the market rallies in a bear market, momentum loses 1.5%. That's a devastating asymmetry. The upshot is that momentum's crash risk is not random noise. It is structurally foreseeable, and it demands an explicit risk management response. All right, we've established what's broken, and we've argued that the causes are different for each factor, namely value and momentum. So let's turn to the solutions, or at least the attempts at solutions. For value, there are 3 distinct practitioner approaches worth examining in depth. They represent genuinely different philosophies about what kind of repair is appropriate. 2 of them, Avantis Investors and Dimensional Fund Advisors, share deep intellectual roots but have reached slightly meaningfully different conclusions. The third, a firm called Sparkline Capital, has gone in a radically different direction altogether. For momentum, the responses are more about implementation and risk management than signal redefinition. So the underlying trade is still the same, but funds have gotten much more sophisticated about when to hold positions, how much to trade, and how to protect against the crash scenarios we just described. Let's start with value. The first firm I want to look at is Avantis Investors, and they are a personal favorite, I will admit. They launched in 2019, founded by a team of former Dimensional executives, including Eduardo Repetto, the former co-CEO of Dimensional. So they carry serious academic and practitioner pedigree. Their philosophy is to take the Fama French framework and update it with the best available research. They make three specific improvements to the value signal. First, they remove goodwill from book value. As we discussed, goodwill post SFAS 142 is a distorting artifact that makes acquisitive companies look artificially cheap. So stripping it out makes the book value a cleaner measure of genuine equity. Second, they add profitability as a joint signal, and specifically they use cash-based operating profitability from Ball, Jericho's, and Nikolaev's 2016 paper. The crash-based measure strips out accruals. The non-cash portion of earnings, the cash-based, not crash-based. I still have momentum on the mind. Pardon me. Which turns out to be noise that reduces the signal's predictive power. The profitability screen solves the value trap problem. And what is the value trap problem? Well, it filters out companies that are cheap because they're genuinely declining, right? You don't want to buy something that's cheap for a good reason. You want to buy something in the bargain bin that people have just overlooked but is still a good product. Third, and this is the key insight, they combine these two joint signals in tandem. They're not just screening value stocks for quality, they're looking for stocks at the intersection of cheapness and profitability. So Norvey Marks in 2013 showed that this combination is far more powerful than either signal on its own, precisely because high profitability firms tend to have low book-to-market ratios. So the two signals pull in opposite directions and together identify companies that are genuinely undervalued. Now, Avantis' approach might sound like the obvious answer, right? And Dimensional Fund Advisors, which is the firm that Avantis' founders came from, and which has been the dominant force in systematic value investing for decades, looked at the same evidence and reached a similar conclusion. So they also rejected using intangibles directly and instead looked at profitability and adjusted value screens. But theirs are a bit different than Avantis's, and we'll see who wins in the long term. So Rizova and Saito at Dimensional published a research paper in 2021 making the case against adding internally developed intangibles to book value. Note that this is a working paper, not a peer-reviewed publication, so treat it accordingly, but it represents DFA's institutional position. Their first argument is about noise. Estimating internally developed intangibles requires capitalizing past R&D and SG&A spending using assumed depreciation rates. DFA compared these estimates to what actually happens in arm's-length acquisitions. When a company is bought, the buyer's accountants value the intangibles precisely. The result, the estimates are very noisy. The errors are large, persistent, and widespread. Their second argument is about data coverage. R&D data only exists for about half the US market. If you adjust the half that reports R&D and leave the other half unadjusted, you're introducing inconsistency rather than removing it. Their third argument is that the intangibles benefit is mostly a sector story. Technology companies have high R&D. Technology companies performed well over the period studied. The intangibles adjustment gives you more tech exposure. Once you control for sectors, the benefit sadly mostly disappears. DFA's preferred fix is this then: better profitability conditioning, especially within sectors. Like Avantis, they argue that value plus profitability properly implemented, already captures what the intangibles adjustment is trying to do unsuccessfully. The third approach to fixing value comes from a firm called Sparkline Capital, and it's the most radical departure from the traditional framework. Instead of tweaking book value or adding profitability screens, Sparkline essentially throws out the balance sheet and tries to measure intangible value directly using machine learning and alternative data. Their ETF is called ITAN, or ITAN. They estimate what they call four pillars of intangible value: intellectual property, patents, R&D spending relative to market cap and brand value, marketing spend, and trademarks. Human capital, well, they take that into account too. They actually scrape LinkedIn to measure the density of advanced degrees in a company's workforce, and network effects, customer data signals. All of this goes into their calculations, and the result is a portfolio that looks very different from anything that Avantis or DFA would build. There's less than 14% overlap with Dimensional or Avantis. ITAN holds a lot of technology, healthcare, and consumer brands, companies that look expensive on book to market but have enormous intangible value. Now, here's where I have to be honest about the limitations, because there are serious ones, and I think that they demonstrate that when you try and get too complicated with something, it can come back to bite you. The track record is very short and frankly underwhelming for this new strategy. Since inception in June 2021 through the May 2024 fiscal year end, ITAN returned 4.76% annualized versus 7.15% for its benchmark. That is meaningful underperformance, not outperformance. And it's failing precisely in a time when value has started to rebound, actually. So the methodology for ITAN or ITAN is proprietary and cannot be independently replicated or audited. And Dimensional's critique about sector bias applies here with even more force. That said, Sparkline may be asking the right question. How do we value intangibles properly, even if the jury is still out on whether they've found the right answer? Now let's look at how practitioners are responding to momentum specific problems. And the most important innovation is something called volatility scaling, which is something that MTUM and IMTM use to great effect. The core insight, developed by Pedro Barroso and Pedro Santa Clara in 2015 in the Journal of Financial Economics, is simple. Momentum's risk is not constant over time. It clusters. The periods when momentum is most volatile are also when it's most likely to crash. And volatility is predictable from recent realized volatility. So instead of just holding a fixed position in the momentum factor, Barroso and Santa Clara proposed scaling the position size by the inverse of recent realized variance. So that means holding more when volatility is low, less when it's high. They targeted a constant 12% annual volatility in their study. The results are dramatic. The Sharpe ratio of the volatility managed strategy is 0.97 versus 0.53 for the unmanaged strategy. They essentially doubled the risk-adjusted return. And the crash risk, the negative skewness, the kurtosis, if you want to use a fancy word for it, largely disappears. Daniel and Moskowitz extended this approach. Rather than scaling only on volatility, they also incorporated forecasts of the conditional mean return, the expected return given the current market state. In panic states, so following a market decline with high volatility, both the expected return and the risk are adverse. So the strategy scales down even more aggressively. They find this approximately doubles alpha and Sharpe versus the static momentum approach. So the important point here, the takeaway, is that this risk management is grounded in an understanding of why crashes happen, not just historical pattern matching, which makes it much more robust. The option-like structure of crash risk in panic states is real and actually foreseeable. So scaling down in those states is a rational response to a known structural feature. Beyond managing crash risk, practitioners have worked hard on two other dimensions of the momentum problem, making the signal itself more robust and reducing the implementation costs. On the signal side of things, the most interesting approach is risk-adjusted momentum. The iShares MTUM ETF, the largest momentum ETF in the world, and I think it's the largest for a reason, doesn't just rank stocks on raw past returns. It divides past returns by trailing volatility. The intuition is that a stock that went up 30% with a very high volatility has a much weaker momentum signal than one that went up 30% smoothly and steadily. The second stock has the more genuine durable momentum. By penalizing high volatility names, the risk adjusted signal reduces cash risk and improves the Sharpe ratio. MTUM also has a clever crash protection trigger. If markets become extremely volatile, it can do a special, unscheduled rebalance using only the shorter 7-month momentum signal. This allows the portfolio to rotate more quickly away from stale momentum positions when the market environment is shifting rapidly. On the cost side of things, AQR has been the most transparent about the problem with momentum and the solution. Their core technique has been trade substitution, and I say has been because, hey, they just closed out all of their momentum strategy funds, and we'll get to that in another video. But anyway, instead of mechanically buying into the single highest momentum stock, their optimizer used to find alternative stocks with similar momentum characteristics but lower transaction costs. This can dramatically reduce the cost drag without meaningfully reducing the factor exposure. Though I should note, as I just did, AQR just permanently shut down all of its focused momentum strategies this year, which will be the subject of another video. And I believe some people are very upset about it, but there are reasons why they did it. Anyway, these are genuine improvements, but I want to be honest about something here. These techniques capture the surviving premium more efficiently, but they don't capture a larger premium. The structural decay in momentum, that 80% reduction from the 1990s to today in premium, is not reversed by any of these approaches per se. These firms are just getting smarter about capturing the remaining premium and perhaps combining it with other momentum like premiums or other kinds of momentums that haven't been captured yet. So let me be direct about what all these momentum improvements actually accomplish and what they don't. So the improvements are real. Volatility scaling genuinely reduces crash risk. I mean, just look at MTUM. Barroso and Santa Clara nearly doubled the Sharpe ratio in their academic study, and risk-adjusted signals produce more stable portfolios. Trade substitution and careful execution meaningfully close the gap between the academic pure premium and what you actually earn. But none of these innovations address the fundamental problem. The momentum premium was roughly 10% per year in the 1990s, and it's roughly 2% today. That 80% reduction isn't a problem of poor execution or inadequate crash protection. It's a problem of arbitrage crowding. Too much capital chasing the same signal has eaten the premium, and no amount of better execution brings it back. This is the key asymmetry between value and momentum. Value's problem is definitional. We were measuring the wrong thing, perhaps, and we can fix the measuring instrument, and attempts to fix it look very promising thus far. The underlying premium, however, cheap assets outperforming expensive ones, remains intact. Momentum's problem is competitive. The signal was real, but it's been partially arbitraged away, and there's no fundamental anchor that creates the conditions for recovery. This doesn't mean you should abandon momentum, don't get me wrong. A smaller, more efficiently captured premium might still be worth harvesting, and I mean, look at the name of my channel. I definitely think it is. But investors should have realistic expectations about the magnitude and should understand that implementation improvements are about capturing what's left, not restoring what's gone, at least for the meantime. There's a beautiful conceptual framework from Nick Baltus and Goldman Sachs published in the Financial Analyst Journal in 2019 that ties everything together. Uh, that paper distinguishes between what is called convergence premia and divergence premia. So, value is a convergence premium. Its whole logic is about buying assets that are too cheap and waiting for them to converge toward their fundamental value. Now, here's the crucial insight. When capital flows into a value strategy, what happens? The value stocks get bid up, their prices rise. The valuation spread, the gap between cheap and expensive stocks, narrows. The prospective premium decreases. This is a negative feedback loop. Crowding in on a convergence premium is self-limiting. The more capital chases value, the smaller the gap becomes, and the less attractive the trade gets. And when the spread becomes very wide, as it did in 2020, that extreme cheapness is itself the signal for future outperformance, the coiled spring, as people like to call it. Momentum, on the other hand, is a divergence premium. It buys things that are going up. When capital flows into momentum, what happens? The momentum stocks keep going up. The trend is reinforced. More capital is attracted, prices diverge further from any fundamental anchor. This is a positive feedback loop. Crowding in a divergence premium is self-amplifying. And because there's no fundamental anchor, no book value, no earnings yield, no one knows when the trend has run its course. The exit happens abruptly and brutally. This structural distinction explains why the two factors problems are so different and why value has a built-in recovery mechanism that momentum doesn't. Momentum's recoveries come from the outside. You've probably heard variations of this argument. Value is set up to outperform. The valuation spread is at historic extremes. When it reverts, value will crush growth. Let me be precise about what that argument does and doesn't mean. The argument has real substance. Arnott and co-authors showed that in mid-2020, the spread between value stocks valuations and growth stocks valuations was at the most extreme levels ever recorded. Literally the bottom percentile of its entire post-1963 history. That is genuinely informative about expected future returns. The 2022 value rally, which was dramatic, partially confirmed the thesis. But there are three important caveats you should sit with. First, timing is unknowable, right? The spread being wide is not a catalyst. It doesn't tell you when the reversion will happen. The same argument that said value was cheap in 2020 could have been made and was made in 2017, 2018, and 2019. Investors who acted on it in 2018 had two more painful years before their thesis finally paid off. Second, if book to market is genuinely obsolete as a value measure, if the intangibles critique is correct, then some of the apparent spread may reflect real economic changes and not temporary mispricing. Whether the spread is really as wide as it looks depends on how you measure value. Third, and most fundamentally, set up to outperform is a statement about unconditional expected returns and not a prediction. High expected returns are consistent with disappointing actual returns over any particular horizon. The premium exists in the long run. There are no guarantees about the short run. The setup argument improves the odds, but it doesn't resolve uncertainty. So let me bring everything together all at once now. Value and momentum are two of the most empirically robust return premia ever documented. Both have faced serious challenges, but the nature of those challenges is fundamentally different, and that difference shapes what investors should expect and do. Value's problem is structural and definitional. The book-to-market ratio has become a noisy proxy for intrinsic value as the economy has shifted toward what some argue is intangible capital. Accounting distortions from goodwill treatment have added further noise. But the good news is these are fixable problems. Adjusting for goodwill, conditioning on cash profitability, and incorporating intangible value estimates can restore much of the signal. And because value is a convergence premium with a self-correcting mechanism, the valuation spread that built up over 13 years of underperformance sets the stage for recovery. though timing remains uncertain on that recovery. Momentum's problem is different in kind. The signal was real, and its logic was sound, but it was too easy to replicate. Post publication arbitrage competed away roughly 80% of the premium. Implementation improvements are real: volatility scaling, risk adjusted signals, smart execution, but they address the crash risk and cost problems, not the structural decay of the premium itself. Momentum lacks a fundamental anchor and a self correcting mechanism. The open questions are real. Fama and French can't statistically confirm that values decline is permanent. So maybe no redefinition is needed at all, just patience. The intangibles literature is still quite young, and so far, not that promising. And we don't have long enough live track records on the new value approaches to know whether the fixes actually work in practice. But the framework is clear. Value needs better measurement and patience. Momentum needs realistic expectations and disciplined risk management. Both remain worth taking seriously, but not uncritically. Well, what could fix momentum? A quick exit of capital, lots and lots of capital, and a fundamental loss of faith in the strategy will, in fact, restore the momentum premium. And since momentum and value are negatively correlated with one another, I hold them both in the portfolios that I design in different ways so that they can correct each other and compensate when each other are struggling. So, that, in a nutshell, is why I always use momentum and value together to capture market trends. Because trend reversal is a trend, as is mean reversion. If you enjoyed today's video, don't forget to like and subscribe, and please leave me a comment. I enjoy questions and commentary and feedback, including pointing out where I might get things wrong. I love having a conversation with my viewers. We've also got some really exciting topics coming up, including a constructed back test of RISR, the RISR strategy, that uses mortgage backed securities interest only strips, a very weird and underappreciated asset class, in my opinion. And we're going to be doing a deep dive on Alpha Architect and its products as well, including AAVM, QMOM, IMOM, QVAL, and IVAL. So that's coming up as well. Lots of really cool topics. And I'm also going to be tackling a user submitted inquiry into tax efficiency and which of the canonical design strategies I've showcased is actually best in a taxable brokerage account and why for US investors. So, a lot of cool things coming up, and I can't wait to share them with you.